Breakout or fake out? This week we saw a number of the currencies move lower versus the US dollar. The dollar moved higher. It still remains king. Is it a breakout or is it a fake out? Let's talk a little bit about it in this Forex weekend report. Hello, ladies and gentlemen. My name is Greg Michalowski from ForexLive.com. This is a weekend Forex report. We're going to talk a little bit about the breakout or the fake out in some of our major currency pairs. This week we had a number of major currencies versus the US dollar break to new lows. The dollar remains king. Let's start with the sterling versus US dollar as it ticked to the lowest level since 1995 on Friday before ticking modestly higher into the close. Retail sales this week fell by minus 1.6% in August and showed broad-based declines in all sectors as consumers reined in their spending in anticipation of higher energy costs. For 3 months, sales volumes were down minus 5.1%. While sales values rose by 5.6%, indicating that sales are tumbling while prices are going higher. The Bank of England meets on Thursday with the expectations of a 50 basis point hike. Meanwhile, the new government will announce an emergency mini budget on Friday where they could go through with a cap on energy for the next 2 years, which will keep inflation from soaring to 20% as some analysts have projected, and instead may even go the other way. That dynamic may take some of the pressure off the Bank of England to hike rates aggressively to rein in the inflation expectations and further weaken the pound as a result. Meanwhile, over in Canada, the US dollar versus the Canadian dollar broke to its highest level since the end of October, early November of 2020 on Friday. Adam in his weekend post here sees a move toward the 137 level as the dynamics of the housing mortgage markets in the US and Canada will keep the trend of buying the dollar versus Canadian dollar intact, with Canadian mortgages being variable, usually 5 years, and US mortgages being predominantly fixed, especially coming off the low mortgage rates seen over the last few years that allowed homeowners to refinance to 15 and 30-year fixed-year terms. As a result, Canadian consumers will feel the pinch from the higher rates as their rates adjust on a rolling basis. Meanwhile, in the U.S., consumers simply need to sit tight, stay in their houses, and not move. See Adam's must-read post here. It's required reading for the weekend. The dollar versus yen tested its highest level since 1998 this past week, but backed off as the Bank of Japan checked rates near the 145 level. Although moving down and closing 210 pips or so from the highs for the year, the fundamental dynamics from the Bank of Japan and the U.S. Fed are still supportive toward the U.S. dollar and against the yen as the Bank of Japan continues their loose interest rate policy and fixed rate policy, and the Fed is intent on slaying inflation and keeping the rates moving to the upside into restrictive territory. Nevertheless, central bank may have set a ceiling for now due to their intervention threat. So it'll be interesting to watch the price dynamic. Do we just waffle up and down in that currency pair, or does the market take on the Bank of Japan and force it to a new high? New Zealand and Australia also broke to new lows for the year and the lowest level since 2020 pandemic. Those countries also feel the pinch from higher mortgage rates as they are predominantly variable, and also feel the impact from China's slowdown as they export commodities and goods to that nation. For the other pairs, the euro versus US dollar fell on the week, but remains within 100 pips of the low for the year and the lowest level since 2002. Will more dollar buying this week lead to its new break lower? We will see. The dollar versus Swiss is its own neutral animal. As such, trades between its 100-day moving average above and the 200-day moving average below. It is also trading near the 50% midpoint of the 2022 trading range. So last week saw a break higher of the dollar versus a number of major currencies. Having said that, as with all new breaks, traders want to see follow-through buying that takes the price comfortably into the new territory. With that said, let's look at the technicals that will confirm or disappoint the dollar break traders in the new trading week. Now that I've looked at the breaks that we saw during the previous week, let's take a look at some of the technicals that would give us more comfort that the break is continuing, or take a look at the things that might disappoint us from the breaks. So let's start off by taking a look at the sterling versus US dollar. I want to take a look at the weekly chart here first. And if we go back to 2020, our lows through here, they came in at the 114.08 to 114.45 level. Again, this is a weekly chart. These are the week lows during that time period. In trading the last few weeks, we've seen the price move down. Last week, we moved down to a new low of 114.045. It was a brief move below that level and then bounced higher and closed higher for the week. Actually, in trading this week, we moved up higher and then came back down, and we're closing somewhere around the 114.15, 16 level. That takes the price back into this range after we reached a new 1985 low, folks, going back to 1985 at 113.496. So we've bounced off of that low and we moved back into this key area here. Guess what? In the new trading week, what traders would want to see is some movement away from these old lows, these 2020 lows, and start to make our way further into the lowest level since 1985. That's what we need to do. We also want to see the price move below this low, this fairly steep to the downside trend line, which when it's really steep like that, it's indicative of perhaps an oversold market. So we're really not into the open road ahead here for the sterling versus US dollar, but we're sitting on the cusp of it. And if we break up below the 114.08 to 114.45 level, stay below that level and move below our lows, below this trend line here, we could see increased momentum to the downside, or we should see increased momentum to the downside in that currency pair. Let's take a closer look at the hourly chart and see where we stand. And if we take a look at the low price here, I mentioned that we went to 114.04. That's this low right here. And in trading on Friday, we did break below that level on our way to the 113.50 level. We did see a rebound higher, and where the price stalled at on the move to the upside was 114.46. Recall again from our weekly chart here, what is this low? 114.45.4. So we stalled right near that 45 level. This area between really 08 to 45 is going to be our resistance area off the weekly chart, and it's our resistance area on our hourly chart as well. This area also corresponds with some nice swing levels through here. Swing low, swing low, swing high through here, and then revisited it on Friday on our way down here, and then break below it and revisit it on the upside. So guess what? The 45 level, that's going to be a key level in the new trading week. If we move above that, we would look for the 50%. We'd look for levels like the falling 100-hour moving average. That's going to be moving down, trying to catch up with the price. But watch the 50% level, and then we're going to start to look toward the 61.8 and the falling 100-hour moving average. Absent that, folks, absent a move back above this area right here and staying above that level, the bears remain in firm control for the sterling versus US dollar. Remember that, and we could start to see further movements into the 1985 lows and more probing to the downside for that currency pair. Let's take a look at the dollar versus Canada next. I'm going to put it on the weekly chart for this pair as well. And as I mentioned in our in the fundamental section, the price moved to the highest level going back to the end of October, early November. That's this area right here. We did reach a high price of 133.072. That stalled around 29 pips or so away from the 50% retracement of the move down from the 2020 high to the 2021 low. So on the top side, that 50% retracement of 113.36 is going to be where we're going to be looking for the market to get to and through on the top side. We also have this top side trend line here where you can see we're closing just below that level that comes in at 132.78. So 132.78, getting above that level, maybe it's a little higher into the new trading rig, so around the 80, 82 or 85 area. Get above that level, and then we're going to start to look toward the 133 level, 133.36. I have this area here also all the way up to 133.83.9. I would think that if we get above and stay above the 50% retracement, we'd make a run toward the 89 level, which is the high of this. You can see a number of different swing levels through here where the price traded either higher or lower in this area right here, the yellow area. We did move above it here in the fail break above the 100 week moving average on these 2 weeks, but as you can see, the market held under that level and stay below. So this is my area here on the top side that we need to get to and through for the dollar versus Canada. Adam's seeing the price move up toward the 137 level. That's a potential on the top side here for that currency pair. And I want to bring you to the daily chart and take a look at that area. Here's around the 137 level. From a technical perspective, I have some swing levels through here and down here and through here and here that I've earmarked near that 137 level. In fact, this high right here came in around the 137.14 level. These lows came in around the same level right here as did these lows right here. So that 137 level is a fairly decent target on the top side. We are back down here on the daily chart, so there is room to roam to the upside. We know that, but that's what we look for in a break, and that's going to take some time to get up to and through that level. Let's take a look at the Aussie versus US dollar next. This is on a weekly chart again, and when we look at this currency pair, I have earmarked or outlined here a swing area that goes all the way back to 2019. Swing low, swing low, swing low, swing low, break to the downside. This is the pandemic. We, by the way, had another swing high right through here before rotating to the downside in March, and then we came back up here, swing high before moving to the upside, and we hadn't returned to that level until this year, where in June or July we moved down to that area. Found support buyers, moved up to the 200-week moving average here, found sellers against there, and over the last 5, 6, 7 weeks, the market's been moving back to the downside here. We did move down into this area right here. It comes in between, let's see, 66.57. Somewhere around there, up to 66.81 for this pair. Let's call 56 to 80 through here. And if we in the new trading week, if we break below that level, I would expect to see more selling here. We are closing the week above that level, so we did test it and we saw the price move back above it. But we'll see what happens in the new trading week if the market's able to get and stay above that level. Taking a look at the hourly chart here, I have outlined this swing area between 66.98, let's call it 67 and 67.17, sort of as a level that if we get below the 67 level, that would be more bearish to the downside and have our price moving down toward our lows, our low targets on that weekly chart. If it were able to stay in this area and base against this area and move higher, the 100-hour moving average at 67.57 would be our target, along with the 200-hour moving average 67.699. So overall, in the Aussie versus US dollar, made new lows going back to 2020, but we held into the support area right here. We're not out of the woods. We're not into the bearish territory here for that currency pair, but we are knocking on the door, and we'll see what happens in the new trading week. Key levels there on the weekly chart. Let's take a look with the New Zealand versus US dollar, and similar to the Aussie US dollar, we are looking down into some key swing levels here. We didn't reach it for this currency pair. Our low price came in at 0.5939, and this swing area where we had swing low, swing low, swing low, swing low. Again, this is on the weekly chart, so these are weekly lows. Come between 59.08 and this low right here, which comes in around the 22 level here, 08 to 22. We reached a low of 39, so got within about 22 pips of that level and found support buyers moved back up toward the 59, 89 level or 90 level, so just below the 60 level there. Key level 0.6000 for the New Zealand versus US dollar. Watch that level on the top side, but on the downside, this is where we need to get below. We need to get below the 59.0809 level, and if we do, we should open the door for further downside here. We'll also be testing this this trend line here on the weekly chart, and getting below that level would be more bearish. That's where we're looking for to continue this trend to the downside in this currency pair. Taking a look at the hourly chart, we moved above lows from last Wednesday, somewhat positive a little bit, but there is work to do. We need to get above this those lows from last week. It's trading, which comes in at 59.96. Get above the 60 level, as I mentioned, off the weekly chart, and then on the hourly chart, we're going to need to get above the 100-hour moving average at 60.18, and the falling 200-hour moving average, which currently comes in at 60.45. Unless the price can move above those hourly moving averages, the bias still remains more in the direction of the downside for this trending to the downside pair, New Zealand versus US dollar. So watch those levels on the top side. If we get above it, we could see some short-term covering. If we stay below it, the bears remain in control, and we'd be starting to look toward our key level here on the weekly chart, going back to the 2020 swing low areas up down to 0.59089. Let's take a look at the dollar versus yen. As mentioned, we did move up toward the 145 level in trading this week. Stalled just ahead of the high price that we saw in the prior week here on September 7th. Our high price right here reached 144.954. This high price reached 144.984. And we started to move back to the downside here on the intervention, or the Bank of Japan asked for rates, and that scared the market, pushed the market back to the downside. Getting above the 145 level is key. On the top side, if we get above that level, it opens the door toward our top side channel trend line, which we're in here. This trend line on the downside, by the way, comes in around the 142.33 level. If we start to break with momentum to the downside below that 142.33-ish type level, we could see further downside momentum in the dollar versus yen. Taking a look at the hourly chart, I think we're going to take our trading clues off of this, because we are sort of consolidating in this range right here. This range has a 145 level on the top side, and on the downside, we have the 38.2% retracement of the move up from the August 23 low. This is a consolidation period. We bottomed through here and then moved to the upside here. The correction on this day right here, that would be in the prior week, reached down right to the 38.2 at 141.47, and we're going to need to get to and through that 38.2% retracement to increase the bearish bias for the dollar versus yen. Remember, any sort of trend move, if we can't get below the 38.2% retracement, the sellers are not winning, okay? The buyers are still in control. So that level is going to be a key level on the downside if the sellers are to take more control. Here, up here around the converged 100 and 200-hour moving average is indicative of a market that's unsure, it's non-trending, and it needs to figure out which way it wants to go. That's as a result of the market trading sideways here, and the two moving averages finally converging. Those two moving averages come in around the 143.30-ish type area, and as you can see in Friday's trade, we traded above and below it, we pretty much stayed below it through the New York session through here. So the sellers are trying to make a play. It's minor, but they're trying, and they need to stay below the 100 and 200-hour moving average to keep that bias to the downside. Let's take a look at the euro versus US dollar, and same familiar story here. We have our box here, and we have our box here for the pair. The high price that we saw in trading last week came right up to this top side trend line, this downward sloping trend line, found sellers here, pushed the price to the downside on the CPI data, but we did find support near the 99.15 level. That level, if you recall, corresponds with our low price going back to, I'm going to go back to the daily chart and bring it out here. Well, it's right here. The low price, the 99.15 or 99.51 level corresponds with our low price here in the month of July, and the price wasn't. The price action stalled near that level on both Wednesday, Thursday. Friday, we moved a little bit below that and then rallied back to the upside. So watch the 99.15 level, just, for giggles and kicks and giggles here. We do need to get and stay below it here. You can see it more closely on the hourly chart here, how the price moved down toward that level here and broke below it, made it move below that level, maybe 5 or 6 pips, and then reestablished the support here on Friday before moving higher. On this hourly chart, the price is trading right around the 100 and 200-hour moving averages at par 11, par 16. Get above that, it's going to be more bullish in the short term. Move below it, and we keep the bears in control here. We did trade up toward the 50% of the range since in the month of September on Friday's trade, but we did find sellers near that level. This level also corresponds with swing highs, swing lows, swing lows through here, and then we came up and retested that level. So the 50% retracement at par 30, getting above that level, and the 35 level opens the door to the upside, as does moving and staying above the 100 and 200 hour moving averages. Finally, I'll take a look at the dollar versus Swiss franc. This is that neutral pair, that neutral country, neutral technicals here for this pair as well. What we can say about last week's trading is the price held the 200-day moving average here and is staying below the 100-day moving average up here. So we're in between those two moving averages on the daily chart. If we go back to this low right here where the market started its base and moved to the upside, the 50% midpoint comes in at the 9577 level. We traded above and below it in trading last week, but on Friday we were able to stay above it. So there's a little bit more of a bias to the upside, but we need to get above the 100-day moving average to kickstart this move back to the upside for the dollar versus Swiss. So I'd love to say that we had big breaks in some of the major currency pairs last week, but we just had sort of minor little breaks that are teasing us to see, and this week is going to determine whether or not we can continue that dollar buying that we saw last week, and continue into new territory on the breaks in some of these currency pairs. So it's going to be a key week for us going forward. We'll pay attention to our technical levels. I've outlined the risk levels for more dollar selling, so pay attention to those as well. And lastly, just going to wish you good fortune in your trading. My name is Greg Michalowski. Talk to you soon. Bye-bye.